So hello everyone, I welcome you all to the second edition of the webinar series organized by Connect Consult in collaboration with Center for Business Development, Innovation Growth, CBDIC. I am Ezra, your co-host, and I'll be doing this with my colleague Swansea. Today's topic is the role of insurance in our lives. Shall we pray? Most gracious Lord, we thank you for this day. We pray for a successful webinar in Jesus' name. Amen.
Amen.
Our speaker for today's webinar is Patricia Ajoko-Quay. She's a chartered insurer and currently works with Enterprise Life. And to our viewers and to our participants, there will be a question and answer session after the presentation. So kindly post all your questions in the chat box. I'll now hand over to Patricia to take over.
Hello, good afternoon, everyone. Ezra, thank you so much. Good afternoon, everyone. I hope we're all well. We're fine and we're excited for today's session. Okay, so today we're going to learn about the role of insurance in our lives, and then also the main benefits and why it's good for us to have insurance policies. So I'm just sharing my screen. Ezra, please confirm when you can see for me.
I can see it, so you can proceed.
Fantastic. Okay. So unfortunately, my video is not working, forgive me, but you can see a picture of me. And this is the outline of my presentation. I'll take you through the definition of insurance, and then we'll also look at some of the core principles. Once we're learning about insurance, it'll be good for you to know some of the core principles, and then the types of insurance, and then we'll move on to the benefits or the role that it plays within our lives. And then we'll have a question and answer section. So our definition, insurance is defined as a legal agreement between two parties. So one is the insurance company, which is the insurer, and then the individual, the person who is signing onto the insurance, who is called the insured. In this agreement, the insurance company promises to make good the losses of the insured on the happening of the insured contingency. So generally, insurance is about paying in the event of a risk occurring. So the risk could be a car accident, it could be a death of a loved one, it could be an illness that somebody contracts. Those are basically the risks that an insurance company is willing to take. And then, so the insurance company promises to pay out in the event of loss when this risk has occurred. And the role of the insured person, which is the individual signing onto the insurance policy, is to pay premiums. For life insurance, premiums are paid on a monthly basis. For general insurance, premiums are generally paid on an annual basis. A lot of companies have different ways they manage this with their clients, but generally that is how insurance premiums are made. So when the insured pays the premium, then the insurance company promises to make good on their promise by paying them their benefits in the event of the risk or the contingency that is covered happening. So now there are 7 principles of insurance. We won't go through all 7 of them, but I want to touch on the 4 basic ones that is important for everyone to know and understand. So there's a principle of utmost good faith, and I want to use the example. It says Jacob took a health insurance policy at the time of taking insurance. He was a smoker and failed to disclose this fact. Later, Jacob got cancer. In such a situation, the insurance company will not be liable to bear the financial burden as Jacob concealed important facts. So when you are signing on to an insurance policy, there's a core principle called utmost good faith. When you are signing on to the policy, the insurance company doesn't know anything about you. Any information you give them is basically what they use to decide whether they want to take on your risk and whether they want to sign you on as a client of theirs and then pay you a benefit in the event of the loss. So if you fail to disclose or you fail to be honest and give them all the material facts, and insurance is called material facts, anything that is deemed worthy to decide whether to cover somebody is called a material fact. If you fail to disclose this, then it means the insurance company is not liable to pay you any claim or any benefit. So in the example of Jacob, for instance, he was signing on to a life insurance company. He smokes and he didn't disclose this. So eventually he contracts or he's diagnosed with cancer. And because he lied from the beginning, the insurance company isn't liable to pay him. The second one, which is also very important, is the principle of insurable interest. Now, again, let me use an example. It says the owner of a vegetable cart has an insurable interest in the cart because he's earning money from it. However, if he sells the cart, he will no longer have insurable interest in it. So if you have insurable interest, what it means is that you stand to lose something in the event that there's a risk associated with the thing that you are insuring. So for example, somebody has a car or somebody has a bus and you own it. It's a means through which you make money or it's a form of business for you. It means that you stand to lose something when something happens to the car, to your car, or to the bus. In the same vein, if you're also covering a loved one, let's say a parent or a sibling, in our African society and in Ghana, if you lose a loved one and they are that close to you, a parent or a sibling, it means that you have a huge responsibility in supporting with the funeral of that person. That means you have something to lose. And so for all insurance, there has to be insurable interest. I can't just get up and say that I'm going to cover somebody else's car, or I want to insure somebody else's car. And when that person has an accident, then I get a benefit paid out to me. No, you must stand to lose something. And that is what we call insurable interest. So the third one I want us to look at is also the fact that you cannot make, insurance has a principle of indemnity. And basically what this means is that if you have a shop and you value the shop at, let's say, 10,000 cedis, and in the event that you your items, you insure this against theft or robbery, and the items are stolen, what that means is that the insurance company is supposed to indemnify you and give you back the value of the shop and the items within the shop, which is the 10,000 cedis. And within insurance, you cannot make a profit. Or you are not supposed to make profit when you sign on to insurance. And this is a very core principle that a lot of people also do not understand or have challenges with. The fourth principle I want us to discuss is the principle of proximate cause. So let me read the example to make it easier for us to understand. It says, all of a building is damaged due to fire. The wall falls down due to a storm before it could be repaired and damaged an adjoining building. The owner of the adjoining building claimed the loss under the fire policy. In this case, the fire was a remote cause and the storm was the proximate cause. Hence, the claim is not payable under the fire policy. So in this situation, somebody has taken on an insurance policy protecting their property in the event of fire. Unfortunately, the person's building is damaged as a result of a storm and not the fire, which is the core risk for which the insurance policy was taken out. So this is what we mean by proximate cause. The risk for which you insured your property or whatever item you are insuring must be the risk that occurs or causes damage to the property you are covering. If it is not, in this case, it was a storm and not the fire, then the insurance company is also not liable to pay. So I'll skip through the others because of time, but basically that gives you a general idea of some of the core principles of insurance. Now, insurance basically works like a pool. So what happens is that numerous people pay premiums, and then benefits are paid out to specific individuals who have losses. And that is why if you have an insurance policy and you are not making regular premium payments, or you stop premium payments, then you lose out on your benefits. Because what that means is that your contribution to the pool at a point in time was used to pay somebody else. Now you have stopped premium payments, but you are expecting that other people's contributions are used to make payments for your loss or your claim, and it doesn't work that way. So everyone within the pool is required to continuously make premium payments to ensure that they will receive the benefits on their policy. Now, generally, there are two types of insurance. We have life insurance, and then we have general insurance. Now, I work in a life insurance company. A lot of people ask me general insurance related questions, assuming that it is the same thing, but they are not. So let me briefly give some examples. I'm not going into details about the definitions, but some examples. So for general insurance, we have things like car or auto. You can insure your car. We have engineering, which is basically like an engineer who constructs buildings and wants to insure those buildings. And then we also have FAR, which also falls under general business. And then we have liability. So professionals sometimes need to get liability insurance, where you could be a medical doctor, a surgery goes wrong, your clients can sue you and such practices. So you need to get liability insurance. And then we also have burglary, that also falls under general insurance. And then also marine, that also falls under general insurance. So there are numerous things. These are just, I think, a few of the common ones that I wanted to share. And then we have life insurance also. There are different types of life insurance policies. We have term life insurance, which is where you take a policy for a number of years, maybe 5 years, 6 years or more. And then we have whole life insurance. This is usually like the death claim or the death policies, where you continue paying until somebody passes away, and that could be for 20 years, 30 years. We have endowment policies, which can be investments, and then we have money back policies, also investments, but related in a separate way. And then we have unit linked, which is also a form of investment, but is the mode of investment that determines how the policy is designed. And then we have children's policy, where you can take a policy for a child, their health or their life. And then we have retirement plans. These are also life insurance policies. So I'll move on quickly to the role, or we can also call them benefits of insurance in our lives. And there are several of them, but I want to focus on 7 key ones. So benefits. If you sign onto an insurance policy before, and I'm hoping that most of us have, you realize that the obvious benefit of insurance is the payment of losses. So let's take it that somebody has a building and they've probably taken out a loan and they are still paying off their loan, and then something goes wrong. And you've insured your building for, let's say, 100,000 Ghana cedis. Now, in the event of a loss, if the insurance company undertakes its analysis and decides to pay, that basically protects you against the loss of that building and then what you plan to do with that building. If you didn't have insurance, what it meant is that you now have to start saving from scratch and then also have to bear the cost of paying out your loan. So insurance helps you to manage loss that will have a drastic effect on you financially in the event that the risk occurs or something goes wrong. Insurance also helps you to manage cash flow uncertainty when paying capacity at the time of losses is reduced significantly. So for example, you have a car that is valued at, let's say, 80,000 Ghana cedis, and then unfortunately somebody runs into you. Now, when that person runs into you, what will happen is that if you didn't have insurance, again, you'll be required to find a way to cough up that money. and fix your car or either get a new one. If you are not lucky and you are the one who runs into somebody, you now have to fix your car and also fix the car of the person who you have damaged their car. And what this does is it helps you to manage uncertainty when it comes to your cash flow. Because what would have happened is that you would become stressed, you become frustrated with having to bear the cost of fixing that person's car and then also fixing your own car. Or you become stressed if somebody hits you because they will now be struggling to find a way to fix your car and then also fix their own car. So in this vein, insurance reduces a lot of tension and negative stress related emotions as a result of financial causes. And then it complies with legal requirements by meeting contractual and statutory requirements, also provides evidence of financial resources. So for example, most of us who have tried to take a mortgage, for example, will know that before you can take out a mortgage, you need life insurance, for example. And this is basically to ensure that the bank with which, or the financial institution with which you are taking out the loan, or whatever property it is that you need, will not lose out in the event of your demise. So it makes contracting and statutory requirements very easy. If there was no insurance, people will struggle to get collateral, to be able to get mortgages, or to be able to get huge loans for their properties. But because we do have insurance, which guarantees that in the event of your passing away, the bank or whichever institution it is that you are taking on the loan or requesting for finances from, will not have to struggle to get money from your family and have to go and seize your property and sell and do all of that. It makes life easy for everybody, and then it helps to provide financial resources. Now, another role of insurance is the efficient use of the insured's resources. It provides a source of investment funds. Insurers collect the premiums and invest those in a variety of investment vehicles. So depending on the type of insurance you've signed on to, we do have investment-linked policies. Now, let me give a practical example. So in a life insurance company, if you sign on to a policy, and let's say you sign on to a 7-year investment-linked policy, and God forbid you happen to pass away within the 2nd year, what insurance would do is to ensure that it will continue the premium payments until the 7th year when your policy matures, so that your beneficiaries, either your children or your spouse, will get a huge lump sum as investments for them. So it helps the insured person make efficient use of their resources, in that if you invest and you don't pass away, you will get good returns at the end of the day. If you do invest and God forbid you also pass away, your beneficiaries, either your children or your spouse, at the end of the term will also have good investment returns on their policies. The other thing that it also helps people make, a way in which it helps people make efficient use of their resources is generally in Ghana, for example, like I mentioned earlier, when there's a funeral, there's a lot of financial responsibility on a core set of people within the family. And what happens if you don't have an insurance policy or you haven't signed on to an insurance policy is that you'll be forced to go and dip into your savings for a funeral, for either a parent or a sibling, or even a child or a spouse. And instead of using your savings for the actual purpose for which you were saving it, you end up having to touch that money and using it for the funeral, which insurance wants to prevent. So insurance is taking on the risk that in the event that somebody passes away, if you sign on to a life insurance policy, then the life insurance company will pay you your benefits, and then you can have your savings clearly kept intact for yourself for future use. Insurance is support for the insured credit. It facilitates loans to organizations and individuals by guaranteeing the lender payments at the time when collateral for the loan is destroyed by an insured event, hence reducing the uncertainty of the lender's defaults by the party borrowing the funds. So unlike what I mentioned earlier, someone can sign an insurance a loan facility, and then, for example, say that they are building a story building to rent out or to use as a warehouse. And for one reason or the other, you happen to have a fire or even have something go wrong, sometimes, and something destroys your building. Now, if you didn't have insurance, what would happen is that you'll be owing the financial facility, let's say like Ghana Home Loans, for example, or a bank, a huge sum of money. And then because your property has been destroyed, you'll not be able to make the profits you intended to make to be able to pay off that loan. So what insurance again will do for you here is that insurance will pay you the benefits in the event that all the principles have been covered and that you did the right thing from day one, and then pay you the benefits to ensure that you don't lose out completely. So they'll pay for the loan, and then you also get funds to be able to continue with your building. It also reduces social burden by reducing uncompensated accident victims and the uncertainty of society. So again, like I mentioned earlier, a lot of the time when there's a car accident and the person involved, for example, like we all know, our trotro people, the trotro driver is not the owner of the car. The mate is not the owner of the car. Neither of them have come close to having the funds to be able to repair anybody's car. And in the event that the owner of the car also doesn't have enough funds, if let's say a trotro driver runs into somebody and injures that person, or even the person becomes hospitalized, if there wasn't insurance, what would happen is that the car owner or the trotro driver or the cover or for even to be able to survive. And so the insurance protects the society by reducing this burden so that people who are victims or who fall victims to other people's negligence or negative things that other people do, and they become victims of other people's actions, they are rightly compensated, and not by the individuals necessarily carried it out, which is like the trotro driver or the mate or the owner of the car, but by the insurance company that the owner of the car has insured the car with. So in this vein, the victim here will not have to struggle to look for money, will not have to struggle to follow the trotro driver or the owner of the car to now come and pay them and compensate them for their medical bill or any further treatment that they will need. And this reduces a burden on society. Because can you imagine what will happen if anybody who happens to be hit, whether it is an individual who is hit or it's a car that is hit, and the person who hits you now needs to go save money and come and pay you? It will be a disaster within our society. But insurance plays this important role within our society by ensuring that when such a thing occurs, because the car is insured, for example, immediately, all the owner needs to do is to make an insurance claim, and then the benefits are paid out to ensure that the victim does not become injured permanently or even lose their life as a result of financial challenges that the owner of the car or the trotro driver or the mate may have. So in summary, this is basically some of the core rules or benefits of insurance to us. I'd like to take any questions, or if anybody needs clarity on what I've gone through, you can please let me know.
Okay, thank you very much, Patricia. That was a very insightful lecture there. We have some questions in our chat box, and so I'll read them.
Great.
So the first one is from Kojo. Kojo says, what happens when an insurance firm fails to indemnify you?
Okay. So there may be a few reasons why the insurance firm will not indemnify you. And usually they'll be clear on this. So one of the core reasons that I know of, I wouldn't want to speculate generally, but one of the core reasons I know is when, let's say, you are insuring your car and you bought the car, the value of the car is 20,000. And then you decide to insure the car for, let's say, a value of 50,000 Ghana cedis. Now, like I said at the beginning, it is you are required to give the insurance company all the relevant information at the time you are signing on to the policy. And this was the principle of utmost good faith. So if at the point of claim, the insurance company now comes to realize that the actual value, because at the point of claim, there'll be some investigations. They realize that the actual value of your car was 20,000 Ghana cedis. What will happen is that you will not be indemnified at the 50,000 that you insured the car for, because the real value of your car was 20,000 Ghana cedis, and that is what will be paid out to you. I don't know if I've answered your question, Kojo.
Okay, so we have a second question. Yes, hello?
Yes, please go ahead.
Question. Yeah, so the second question is from us, same Kojo. He says, averagely, how long does it take for an insurance firm to indemnify you?
Okay, so it depends on the type of claim, the type of policy you sign on to, and then also the reason for the claim or the risk that has occurred. And every company has a different promise they give to their clients. So for life insurance, generally, some will say maximum within 5 working days, or some will tell you 48 hours, others will say 72 hours. For general insurance, it can be a bit longer because, for example, if you've insured property or a huge building and a part of that building is damaged, they'll need to send out professionals to your building site. They'll need to inspect your documentation and do some due diligence and then confirm the extent of damage, the cost of damage, and all of that can take some time. But every insurance company has its own timeline, which it promises to pay its clients benefits. And usually this will be stated in the terms and conditions of the policy at the time you are signing on. So it's good, and it's a good question, Kojo, and it's very key that before you sign on with any insurance company, you know what their claim philosophy is, you know what their timelines are, and then you also do some background checks to see if you know anybody in your family or amongst your friends who has had an experience with them, to know how long averagely it takes them to pay out a claim before you also sign on with that insurance company. Thank you. Ezra, please, any other?
Right. Yes, there's one more question.
Great, okay.
Okay, this one is from Ado. He says, what's the maximum age required to insure your parents' life?
Okay, so again, this is dependent on the insurance company and then the type of policy that they are running. So some insurance companies will tell you 74 years, others will tell you 100 years, some will say 80 years. It depends on the insurance company and the kind of risk that they are willing to bear. So if you are signing on an aged life, for example, in terms of the age, you are signing on somebody who is older. What it means is that there's a higher risk of having to pay the benefits within a shorter period of time, because an older person obviously is getting closer to their maker. And what that means is that it will require you to pay higher premium because it's very likely that the insurance company will have to pay you the claim. So some companies decide to reduce their risk by staying within some age ranges, which would be like 74 maximum. Others may decide to go a bit higher than the and take on a higher risk by going to an 80 or 85. And some also want to make a mark in the markets and know that whatever it is that you bring to them, they are willing to take on that risk because they have the financial muscle to do so, and say that 100 years will be their maximum age limit. But there's no statutory requirements, there's no statutory age. It depends on the insurance company and then the kind of risk that they want to take on in terms of the age of the people that are covered on the policy. Thank you.
All right, thank you. There's another question. This one says, can you kindly suggest, it's from Ado. He says, can you kindly suggest some firms where I can insure?
Okay, Ado. So for me, I would suggest that you can get in touch with Ezra and get in touch with me directly. I wouldn't want to recommend here, but when we have a conversation and I know exactly what it is you are looking for, then I will know what to recommend for you. Because there are several general insurance companies, there are several life insurance companies, but I need to know exactly what it is that you want to even know which company and then which type of product it will be good for you to sign on to. So please get to my details and you can get in touch with me. Thank you.
All right. Okay, thank you. To our participants, if anyone has a question, you can kindly put up your hand and then we'll unmute you and then you can give a question.
Yeah, so I have a question.
Please go ahead.
Okay, thanks for the presentation.
You're welcome.
My question, you made mention of when you sell your whatever you're insuring, you loses your insurable interest. Is that so?
No, I was saying that to be able to have insurable interest, it means that you stand to lose something before you can have insurable interest. So for example, if you want to insure your house, because you stand to lose something, if there's a fire or a theft, that means you have insurable interest. But you can't insure somebody's house. If that person's house gets burned down or is robbed, you will not lose anything. So that means you don't have insurable interest in somebody else's house.
Okay. So in a situation where, a typical example is in a situation where you have a vehicle that you've insured, and you sell that vehicle, that means that you don't have any form of insurable interest anymore.
No, please. Okay. You do not. Yes.
Okay, so I wanted to know whether in this case, we have, in accounting, we have something like the principle of substance over legal form, where you can transfer, you can sell the asset, but you still have the right to use of that particular asset. So in that case, are you looking at it from the point of view or using the right of use of that particular asset?
Okay, so the view is, or the standpoint is that in the event, let's say it's a car, in the event that there's damage to that car, you have sold off the car. You will not have to bear any loss financially in repairing that car. If the car is used to hit someone and there's a victim involved, you will not have to bear any part of the financial responsibility in paying to cater for that victim or even to repair somebody else's car. So once you will not lose out financially in any way or form, then it means that you do not have any interest in that car.
Okay.
So it can be same with the house, it can be same with the shop. It doesn't matter what it is. Once you've sold it out to somebody else, and it is no longer yours, it means that you will not lose financially when something goes wrong.
Okay, so thank you, Kojo, for your questions. So we thank all our participants for joining into today's session. We thank our guest speaker, Patricia. That was a very insightful webinar, and we are very grateful. To all those who couldn't join in, we'll send the recorded version to all of you, and you can follow us on YouTube, Facebook, and all our social media handles at Connect Consult and CIBDIC. Thank you all for joining.